What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about banks' earnings. So 3 of the 4 largest banks in the US are going to be reporting their earnings on Friday. So wanted to break that down and how there is going to be some multiple forces at play with respect to deposit flight. So we've heard deposits going in, but we've also heard deposits going out. So it's actually going to be very interesting what these companies end up reporting. So JP Morgan, Citigroup, and Wells Fargo, all 3 are scheduled to report earnings on Friday morning. And I'll break down, do like a quick comparison on the banks, go over the valuations, the current condition that they're in, and of course, go over the technicals as well. So hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, don't forget, you can get access to that 16% annual discount available till the end of this month. And I also did share the trade ideas video with all the members. So this is a private Patreon video that you can access and watch and get access to all the trade alerts, buy alerts, options alerts, and of course all the other member benefits as well. So this is the earnings calendar. So Friday, we've got the big banks reporting. So Citigroup, JP Morgan, and Wells Fargo are going to be scheduled. And they are expected to report deposit flight in the upcoming earnings. And customers pulled almost $100 billion from big 4 retail lenders in the first quarter, according to analyst forecasts from Bloomberg. So Bank of America actually reports on April 18th. So they're not this week, but next week is when they're going to be reporting earnings. This week, we also do have BlackRock reporting, and then Goldman Sachs and Morgan Stanley, they're more on the investment banking side. But if you read, the largest US banks are expected to reveal this week that customers withdrew tens of billions of dollars in deposits at the start of 2023, even as they gained new customers following the collapse of Silicon Valley Bank. So a couple things are going to be very important: deposits, the guidance, the actual earnings itself. The margins are going to be incredibly important as well, because higher interest rates are really dragging that deposit beta, which I will talk about later in the video. But analysts are forecasting that depositors seeking higher interest rates from alternatives such as money market funds pulled almost $100 billion in aggregate from JP Morgan, Bank of America, Citi, Wells Fargo in the first 3 months of 2023. Now, this $100 billion will certainly get a net effect, because, we did see $100 billion get pulled out because of the higher interest rates that money market funds are paying. And we also talked about the money market funds hitting a new record at over $5 trillion because of the higher interest rates. But at the same time, when you have Silicon Valley Bank failure, lots of commercial bank failures, you've got that money getting pulled out and going into Big 4. So there's been kind of like 2 forces at play, where on one side you've got money being pulled out, on the other side you've got money coming in. So net, I am still expecting some decent numbers from these banks going into this earnings report. And if correct, it would come despite the failures of SVB and Signature Bank in March, which sparked customers to move deposits from smaller regional banks into the bigger ones as well. Deposits are typically banks' cheapest source of funding, and reduction could constrain lending. So if the banks don't have enough deposits, obviously they're not going to be able to lend as much. And the big banks have steadily been losing deposits for the past 12 months as the Federal Reserve has raised interest rates, because investors and market participants, as depositors, can go elsewhere to earn a higher yield on their deposits, as opposed to just keeping it in the bigger banks and pretty much yielding nothing or close to nothing. So Jason Goldberg, research analyst at Barclays, says, and I quote, "The number 1, 2, or 3 things to watch this quarter are deposits, deposits, deposits." Those are the 3 things. And this is how much the deposit base has been coming down. So big US banks expected to lose more deposits in the first quarter. And JP Morgan, as you can see from first quarter 22, so over the last 12 months, have just been going down significantly. And so is Bank of America. And so is Wells Fargo. Citigroup, I would say, is rather stable. So it hasn't really seen a significant pullback in the deposit base, but definitely trillions of dollars are being moved out of the big 4 in the last 12 months as interest rates have really gone up. So JP Morgan, Citi, Wells Fargo report earnings on Friday, followed by Bank of America on April 18th. And on average, first quarter revenues at the big 6 big US banks are expected to rise just over 6% on a year-over-year basis, while earnings per share are expected to increase by just about 1%. So pretty much flat year-over-year numbers. And analysts expect revenues will rise most at banks with large retail operations, namely JP Morgan, BofA, Citi, and Wells Fargo. Investment banking is still under a lot of pressure because we're not seeing as many deals happen. We're not seeing a lot of M&A activity. And forget about IPOs. I mean, hot IPO days are way behind us, and SPACs I can't even remember what SPACs were like, because you were seeing pretty much every single month hundreds of SPACs, hundreds of IPOs, and those days are way behind us because we are seeing a big slowdown. Deposit in commercial banks in the US has also gone down substantially. So deposits in trillions of dollars have gone from 18 down to 17.2 trillion. So almost about $800 billion have been pulled out since the first quarter 22, since the last 1 year. And that liquidity has to go somewhere. Well, it has gone to the actual money market funds, which has been hitting a record high. So you can see that from 2022 to 2023, we've just been pushing higher. This has just been going parabolic as interest rates given on the money market funds have also hit record highs at $5.1 trillion in assets under management. A few more things here. Margins will also come under pressure because the deposit betas are accelerating. And what that means is that as deposit betas are nothing but the bank's commitment to paying depositors. How much are they going to pay, right? So this is one of the cheapest form of borrowing a bank can have, right? So if you go and deposit your money with the bank and they're giving you 0.005%, that is the cheapest way they can get access to money, right? If they're not paying you anything, they practically have that deposit for free, right? And they can turn around and start lending that money at 5%, 6%, 7% at the market rate and make that interest, right? Make that net interest margin. But deposit betas are pretty much when it starts to compress, right? When that margin starts to compress. Why? Because if other banks, competing banks start to pay higher interest rates on their deposits, well, some of the other banks will also have to follow. And as a result, margins will compress. And that's exactly what's going on as U.S. banks are lagging behind the broader market in the first quarter of 2023, and margins are certainly under pressure because of this very phenomenon. And of course, we've seen banks under a lot of pressure. As a result, the S&P 500 doing a lot better than the banking sector. I do still have a long position on FAS, so that's something that I'm definitely paying attention to. And, yesterday it was up 2.6%, so I did trim a little bit at those prices and will continue to trade this, and my target's all the way up to $68, $69, a bit more optimistic, but I think we can get up there if they are able to report some good numbers and some decent earnings growth, revenue growth. XLF, which pretty much has the top banks we're going over in this video, up another 34 basis points after being up almost 1% yesterday. And the deposit flight at big banks during the first quarter expected to have been partially offset by a rush to safety by customers in the wake of the collapse of Silicon Valley Bank. I think what's going to be interesting is when these brokerages start reporting their numbers. Their deposit flows should be pretty high, right? You got Fidelity, you've got TD, you've got a lot of these broker houses or trading houses that allow depositors to invest their money as well, but then also allow them to have money market funds, which I think is going to be quite interesting considering what we're seeing with the money market funds. Assets under management over $5 trillion at record highs. So going very quickly over to some of these stocks here. So JP Morgan, Bank of America, Wells Fargo, Citi, Goldman Sachs, and Morgan Stanley. Of course, the performance has almost been identical year to date. They're almost all down except for Goldman Sachs, which is except for Morgan Stanley, which is only down about 0.73%. Everything is down except for also Citigroup, which is surprisingly higher on the year, up 3%. Citigroup is also, I would say, one of the best of the bunch considering all these 6 names. The second one comes to mind, a JP Morgan, but if you come down a little bit here on the list, you'll notice that the actual valuation, the price to book, on a trailing basis, Citigroup trades at the cheapest valuation at 0.5 compared to some of these companies, Bank of America, Wells Fargo, trading at under 1, which is still favorable. And then we've got 1.42 for JP Morgan. And we got Goldman Sachs trading at over 1 and Morgan Stanley, the least attractive at 1.56. But then you got price earnings multiple. All of them are practically the same at 9, 10, around those levels. Once again, you've got Citigroup trading at around 6, 7, 8. So one of the cheaper stocks among this set of stocks here in the banking sector. And then valuation, we've already gone over. But in terms of revenue expectations, so if you come over to JP Morgan, and I'm going to quickly go over to earnings expectations. Their earnings estimates for this upcoming quarter is going to be, let's take a quick look, is going to be $3.40 is the EPS gap estimate, and revenues expected to be at just over $35.6 billion. And then finally going over to Citigroup very quickly. So earnings are going to be expected at $1.70 with a revenue of just over $20 billion. So we have seen revisions to the downside, right? It's not like they are not revised. We have seen 6 revisions on the downside for Citigroup. And even from a technical standpoint, that's the one that actually makes a lot more sense because we have been trading inside this uptrending channel for Citi. So if I come over to the weekly chart, you'll notice that we did come down, bounced off of that level. Previously got up to as much as $52, $53, sold right back down. And once again, we're kind of trading inside this uptrending channel with this being the higher low for Citigroup at the moment. And JP Morgan here, very quickly, we're also seeing a very decent move, more or less consolidation sideways. So we did push higher after consolidating sideways for quite some time after selling off in this downtrending channel, pushed up to as much as 143, then sold right back down. And right now we're just testing that support at roughly around $128, $125 per share. So this right here is going to be that support level to watch for JP Morgan going into these earnings. And then finally, Wells Fargo is also reporting on Friday. So we are seeing a little bit of bounce back higher. So I do expect some reversals for these banks collectively. That's why I'm long on FAS to begin with. And that's going to be a pretty big play going into Friday, because if there is a lot of volatility, of course, FAS is definitely going to be moving a lot because it is leveraged in the first place. But Wells Fargo, of course, very nice uptrending channel here, higher highs and higher lows. And then the Silicon Valley Bank failure came along, sold right back down, very, very oversold, and also trading in and around that support here at roughly $35, $36. So this also makes for a good reversal trade opportunity for it to push right back up, and resistance is going to be at $47, $48 for this company moving forward. So this right here is going to be that target and that potential resistance to watch for Wells Fargo. So bottom line is, all three of them going into these Friday earnings do look like there is potential for a reversal trade, considering how oversold these are. It's just a matter of how good the earnings end up being and how good the guidance is going to be with respect to deposit bases and the margins for this company as well. So I'll update you guys as soon as I, of course, get the reports. But I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Let me know your thoughts on these banks, and are you buying, selling, holding any of these banks? We'd love to know down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining, 16% annual discount till the end of this month. As always, happy investing, and I'll see you all in the next video.